Have you ever wondered why the richest investors on earth seem to get richer when the world is falling apart? Why they stay calm while everyone else is losing their minds? Here's the truth that 99% of people never understand. Market crashes don't destroy wealth, they transfer it. Every major fortune you've ever heard of, from Warren Buffett's empire to the silent billionaires who never make the news, was built on one brutal principle. When others panic, they buy. Not because they're fearless, not because they're geniuses, but because they understand the psychology of fear better than the people drowning in it. Let me blow your mind for a second. When the stock market drops 30%, people think that 30% of the wealth just vanished. Poof, gone. But did it really? No. The companies are still there. The employees are still working. The buildings still stand. The products are still being sold. What actually disappeared was confidence. The price didn't fall because the business failed. It fell because humans did what humans always do. They panicked. It's like this. Imagine you own a rental property, great location, solid tenant, steady $1,500 a month in rent. You bought it for $200,000. Then the housing market crashes, and now it's worth $140,000. Did your tenant vanish? Did your rent stop coming in? Of course not. Nothing real changed. Only the perception of value did. That's the illusion most investors never see through. The stock market works the same way. The businesses don't stop making money just because the headlines scream crisis. But fear spreads faster than logic, and before you know it, people are dumping assets like they're toxic. Prices collapse. Fear deepens. More people sell. It's a perfect storm of emotion, and it's during that chaos that the calm quietly become the wealthy. Because here's the irony. During a crash, everything is suddenly on sale. The same assets, the same cash flow, the same businesses, just cheaper. But instead of seeing a clearance rack of opportunities, most people see the apocalypse. The few who don't, the ones who stay calm, detached, and rational, they're the ones buying when everyone else is running. Let's talk real numbers. During the 2008 crash, the S&P 500 fell from 1,500 points to 700, a 53% collapse. If you'd invested $10,000 at the bottom, by today that would have grown to roughly $60,000. 6 times your money. That's not luck. That's discipline under fire. That's the Stoic principle of acting rationally when emotions are irrational. Now imagine compressing 19 years of typical growth into just 15 years. That's what happens when you invest in panic instead of being ruled by it. It's not timing the market. It's understanding human nature. And before you say, but what if it keeps crashing? Ask yourself this. How many times has the market recovered in history? Every single time. The Great Depression, the dot-com bubble, the 2008 collapse, even the 2020 COVID panic. Every crash that once felt like the end of the world eventually became a launch pad for those who stayed calm. So the next time the market burns, remember this. Fear doesn't destroy wealth. It simply transfers it. From the emotional to the stoic. From the panicked to the patient. From the crowd to the few who understand what's really happening. Because true wealth isn't made when times are good. It's made when everyone else is too afraid to think clearly. In record time, he recovered. The question is not whether the market will rebound, but rather when, if you are investing funds that you won't need for 5 to 10 years. And if you're patient, it doesn't matter when. However, the majority of individuals do this instead. When markets are high, they purchase because everyone is feeling upbeat. They then sell in a hurry when the markets plummet and everything goes up for sale. In actuality, they are selling low and purchasing high. The complete opposite of how wealth is created. During a crash, you have the chance to break that pattern, buy cheap when everyone else is panicking, and accumulate assets at prices that won't be available again once the recovery begins. What I refer to as the compounding accelerator is the second huge benefit. The true magic occurs here, and most people are totally unaware of it. Investing during a crash entails more than just purchasing things at a discount. You're getting a huge discount on future compound growth. Allow me to clarify with a specific example. Consider making a $1,000 monthly investment in an index fund. Under typical market circumstances, Each share of the fund costs $100. You can purchase 10 shares for $1,000. The market is now down 50%. Each share in the same fund now costs $50. You can now purchase 20 shares for $1,000. For the same amount of money, you will receive twice as many shares. The obvious element is that. However, this is what people overlook. You received an additional 10 shares during the crash. For decades, they will continue to compound. They will expand with each market recovery. When the business succeeds, they will part ways. Dividends will be paid and reinvested by them. The additional shares you acquired during the crash could account for 30 to 40% of your entire portfolio worth in 20 years. You didn't make a larger investment. You just made a better investment with the same amount of money. And over time, that disparity adds up to enormous riches. Consider it this way. For 30 years, two individuals invested $1,000 a month with the same consistency and discipline. The first person makes investments consistently, even amid crashes. The second person stops investing until everything feels safe again because they get afraid during crashes. With a few significant falls over the course of 30 years, an individual may finish up 50 to 70% wealthier. Same amount each month. The sole distinction is that during the crashes, one continued to purchase. The compounding accelerator is this. You're not merely purchasing discounted stocks. Decades of future progress are being purchased. And this effect gets worse the sooner in your investing career you encounter a crash. In reality, a fall in your 20s or 30s is a gift. It will take decades for those inexpensive shares to compound. A crash just before you retire in your 60s. The fact that you don't have time to recover makes that more troublesome. However, there's a timing problem rather than a core problem with the plan. I refer to the transfer mechanism as the third reason why collapses generate wealth. Although it is really important to comprehend, this is the awkward aspect that no one really wants to discuss. A market fall does not mean that wealth vanishes. It moves people from sellers to buyers, from impatient to patient, and from emotional to disciplined. This is what really occurs. Investors that are afraid sell their shares when markets drop. To escape, feel secure, and avoid the agony of seeing their portfolio decline, they're prepared to take far lower prices. To whom are they selling? Those shares must be purchased by someone. And that someone is the composed investor who sees the chance. There are two parties to any transaction, the buyer and the seller. In the event of a crash, the seller is taking a huge loss. A huge discount is being given to the consumer. After 5 or 10 years, the market has bounced back and reached all-time highs. The seller locked in their losses when they sold during the crash. That money is never returned to them. The investment of the person who made the purchase during the crash may have quadrupled or tripled. The funds did not disappear. It recently changed ownership. It moved from the person who freaked out to the one who remained calm. Every wealthy investor made their fortune in this manner. Not by luck, not by knowing something that others don't know, and not by being prepared to purchase when everyone else was selling. Be fearful when others are greedy and greedy when others are fearful, as Warren Buffett once stated. That statement is more than just adorable. That is the actual method by which wealth is transferred. Prices are high when everyone is greedy. You're spending a lot of money. Prices are low when everyone is scared. You're receiving savings. The market's wealthiest individuals are not the ones who stay out of accidents. They're the ones who welcome accidents as learning experiences. And this is what gives it its special potency. The distribution of wealth is not arbitrary. It's not a stroke of luck. It is a recurring psychological pattern that occurs during each business cycle. Selling is a result of fear. Low prices are the result of selling. Opportunities are created by low prices. Wealth is created by opportunity. For people who remain logical, the F, what I refer to as the psychology bypass, is our worth advantage. This may be the most crucial of all, as knowing it will enable you to act in the event of a collision. The thing about market crashes is this. In retrospect, things feel different than they appear. It seems like the world is ending when you're experiencing a crash. The news is alarming. Everyone is in a panic. Your portfolio is losing value every day. Your brain is urging you to take action in order to halt the bleeding, sell, and safeguard what's left. Here's what your brain doesn't comprehend, though. This emotion, this anxiety, this panic is the exact clue that you ought to make a purchase. Consider it. What are the best pricing available on the market? When everyone is most frightened. When is the most frightening moment for everyone? During collisions. Therefore, the buying opportunity is likely to be better the worse you feel about the market. There is an inverse relationship between investing opportunity and your emotional suffering. I realize this sounds crazy. Despite your body's instincts telling you otherwise, the facts are crystal obvious. At the time, all of the greatest purchasing opportunities in market history felt awful. It seemed like capitalism was ending in March 2009. It seemed like the end of the world in March 2020. 1,987, 2,000 identical. And each and every time, those who were able to ignore their anxiety and continue investing gained fortunes, while others who succumbed to their fear and sold locked in enormous losses. This is the shortcut to psychology. It's realizing that your perceptions of the market are typically inaccurate. When stocks make you feel good, they're most likely pricey. When stocks make you feel bad, they're most likely inexpensive. Now, how do you go about doing this? When everything feels bad, how can you invest without using your psychology? 2 tactics. Automate it first. Establish automated investments that take place irrespective of your emotional state. You cannot let your feelings get in the way of your decision if it has already been made. Reframe the pain second. You shouldn't assume that I'm losing money when your portfolio declines. I believe that everything has just gone up for sale, and I plan to purchase more shares with my next investment. The event is the same. However, the framing fundamentally alters your behavior and emotional reaction. The fifth and last justification is what I refer to as the survivor's advantage. This concerns the aftermath of the crash, which may be much more significant than the actual collision. The majority of people are unaware of this. Businesses that survive a crash tend to emerge stronger. Weak businesses fail. Strong businesses endure. In fact, the most powerful businesses increase their market share. Thousands of banks failed during the 2008 financial crisis. However, the large banks that made it through grew larger. They acquired their defunct rivals. They brought the industry together. They emerged more powerful than before. The 2000.com crash caused hundreds of online businesses to fail. However, Google and Amazon both made it through. And for the next 20 years, they controlled the internet. Every collision serves as a stress test. It shows which businesses were simply coasting on favorable market conditions and which are genuinely strong. Purchasing a broad index fund during a crash entails purchasing the entire market, which comprises all of these companies that will survive and become stronger. The worst part is still to come. There is typically a period of tremendous expansion following a crash. The economy begins to revive, the strong are hungry, the weak are gone, and the businesses that are left develop more quickly than they did prior to the catastrophe. Your portfolio's companies aren't simply going back to where they were. Because they are stronger, leaner, and encounter less competition, they are frequently outgrowing them. The benefit of the survivor is this. Investing during a crash allows you to take advantage of the accelerated growth that frequently ensues in addition to the recovery. Take a look at what transpired following 2008. The ensuing bull market continued for more than 10 years. It was among the strongest and longest in recorded history. The businesses who made it through became titans. Or consider 2020. Following the COVID crash, there was an exceptionally robust recovery. The value of the businesses that adjusted increased. Every cycle, this process is repeated. Crash, survival, recuperation, and rapid expansion. Additionally, those who made investments at the time of the crash got to enjoy the whole wave. This is when the exciting part begins. And some people might feel uneasy about this. Not all of what I just explained is theoretical. Wishful thinking is not the case. For more than a century of market history, this has been the method used to generate money. However, no one wants to acknowledge this. It is rare for most people to do this. Similar to the previous crash and the one before it, the majority of individuals will panic and sell during the next crash. Why? Because doing something is far different than knowing what to do. You're doing more than just battling your feelings when the market is collapsing. You're battling the feelings of your family. The news media yelling that everything is collapsing, and your friends' feelings. Your colleagues discussing their losses. Everyone around you is in a panic. And one of the hardest things a person can do is maintain composure in the face of panic. It contradicts all of our evolutionary instincts. The brain encourages you to flee when everyone else is fleeing from danger. Our forefathers survived because to that impulse, but it ruins investment returns. This is the harsh reality. Some people get wealthy as a result of market crashes because most people are unable to withstand them. There wouldn't be a crash if everyone could remain composed and continue making investments. Prices would not decrease. The fear is what creates the opportunity. The worry is genuine, too. It's not illogical. It's incredibly human. For this reason, financial education alone is insufficient. All of the data is available to you. Understand the entire past. Even if you understand that collapses are buying opportunities, you may nevertheless become alarmed when your portfolio falls 30% in just 2 weeks. When the stakes are this high, emotion cannot be subdued by knowledge. Something more is required. A system is necessary. You must automate. Before the crash occurs, you must make choices. Because you won't be logical in the event of a crash. No one is. Successful people aren't more logical. Simply put, they're more prepared. Prior to the crash, they had their automated investments set up. Before the crash, they put their plan in writing. Before their feelings became engaged, they made a commitment to their plan. They don't need to have courage when a crash occurs. They don't need to be intelligent. All they need to do is follow the strategy they came up with when they were rational. The true secret is this. It's not about having no fear in an accident. It's about automating the decision before your fear manifests itself, thereby eliminating the need to be brave. Allow me to introduce you to David. In 2006, David began making investments. He was 28. He started contributing $500 a month to a retirement account and had an excellent job. David saw the growth of his account for 2 years. He had invested roughly $15,000 by the end of 2007. He thought he was brilliant. The market continued to rise. His equilibrium continued to improve. Then 2008 came along. It was the financial crisis. David saw his $15,000 plummet to $10,000, $9,000, $8,000, and so on. He would see red numbers when he logged into his account every single day. Every day seemed worse than the one before it. The information was horrifying. It was being likened to the Great Depression. Before he lost everything, his parents advised him to withdraw his funds. By March 2009, David was at his breaking point. He still had roughly $7,000. He converted everything to cash by selling it. He promised himself that once things calmed, he would return. The market had already regained 30% by the time it seemed safe to do so again. David continued to wait. He eventually returned in 2012 or such. The market had more than doubled from its lowest point by that point. David continues to invest now. He is doing well. This is what he is unaware of, though. He lost hundreds of thousands of dollars in future riches as a result of his March 2009 sale. His portfolio would have been worth roughly $200,000 more than it is now if he had just persisted in investing his $500 monthly income through the crash. The $200,000 is gone. He missed the opportunity because he didn't grasp it, not because the market let him down. Let me now introduce you to Lisa. In 2006, Lisa began investing as well. David's age and monthly income are identical. Lisa witnessed the 2008 crash as well. Her portfolio fell. She experienced the same terror that David did. The same alarming news reached her ears. However, Lisa took a different action. She studied market history prior to beginning to invest. She was aware that crashes occurred. She was aware of their transience. She was aware that the market would always eventually rebound. Therefore, Lisa made a choice when 2008 arrived. She failed to sell. She actually raised her monthly investment to $750. She reasoned that she should purchase more, not less, if stocks were on sale. Was she afraid? Of course. Did she have self-doubt every day? However, she placed greater faith in the evidence than in her feelings. Lisa made investments between March 2009 and the end of 2010 while the market was still weak. She amassed stock at values she would never see again. Let's fast forward to today. Lisa's portfolio is valued at approximately $450,000. David's portfolio from the previous article was valued at roughly $250,000. For the most part, the beginning point and monthly contribution remained the same. There was a $100,000 discrepancy as David sold and Lisa invested during the crash. Here's what's truly intriguing though. Lisa doesn't think she accomplished anything noteworthy. She doesn't consider herself a hero or a genius. She only complied with one regulation. Continue making investments. Avoid checking the account too frequently. Have faith in the long-term data. That's all. No particular expertise. No intricate plan. Just the self-control to continue doing the tedious task while everyone else was in a panic. David claims that his timing was unlucky. Although Lisa doesn't discuss it much, the data clearly shows otherwise. The majority of individuals are unaware of these facts regarding investment and market crashes. And this could fundamentally alter your perspective on danger. Actually, it has nothing to do with market prediction. Timing the bottom isn't the point. It has nothing to do with having courage in a collision. It all comes down to realizing that risk and volatility are two different concepts. The risk is not the market declining. You run the danger of panicking and selling. Consider it. Temporary crashes are only noise if you invest in reliable businesses or wide index funds and keep them for decades. All they are is erratic, unpleasant, frightening, and uneasy noise. However, you convert that noise into irreversible loss if you sell during a crash. You take a momentary volatility and turn it into irreversible harm. The crash is not the danger. Your reaction to the incident poses a risk. This reframe is the one that makes all the difference. Due to market crashes, the majority of people believe investing is dangerous. However, that is reversed. Wealth is created through investing when markets tumble. Not the bug, but the feature. The discounts are caused by crashes. The disproportionate returns are caused by the discounts. Wealth is created by the disproportionate returns. Everyone would receive mediocre profits if there were no crashes. The majority of people are unable to cope with the short-term discomfort, which creates an opportunity. Therefore, it's not entirely accurate to say that investing is risky. The unpredictability of investing is unnerving. However, the volatility turns into an opportunity if you can bear the discomfort without becoming alarmed. The distinction did not lie in Lisa's luck and David's bad luck. It was about realizing the true meaning of danger. David sold because he believed the crash posed a risk. Lisa remained invested because she recognized that her feelings were the danger. The same data, entirely different frames, and entirely different outcomes. And this is something that could blow your head. It will feel just like the last crash when it happens again. Uncertain, frightening, and akin to the end of the world. Additionally, it will be an opportunity masquerading as a disaster, similar to the previous crash. Whether you'll see it this time is the question. Let's review why it is possible to become wealthy by investing during crashes. The window for discounts. Your wealth accumulation is accelerated by years or decades when you purchase the same assets at a discount of 30 to 50%. The accelerator for compounding. The additional shares you buy at a discount compound over decades, eventually making up 30 to 40% of your total. The process of transfer. In times of crisis, wealth does not vanish. People simply go from panicking to remaining calm. The psychological shortcut. There's typically a negative correlation between opportunity and fear. The worse you're feeling, the better the chance to buy, and the benefit of the surviving. Businesses that survive crashes typically come out stronger and expand more quickly than they did before. These are not hypotheses. These are not idealistic thoughts. For more than a century, These trends have recurred throughout every market cycle. Crash events are not avoided by those who amassed wealth in the market. They accepted them because they saw that momentary suffering leads to long-term opportunity, not because they were braver or more intelligent. The empowering part comes next, and you can accomplish this. Having a lot of money is not necessary. You don't have to be an expert in finance. All you have to do is set up automated investments and continue with them during the uncertain times. That's all. That's the entire plan. Make regular investments. When there's a crash, keep moving. Hold off for decades. Become wealthy. Not understanding is the difficult part. Doing it while everyone is freaking out and your portfolio is collapsing is the difficult part. Here's what I want you to keep in mind, though. The next crash is on the horizon. When it's unknown to us. It's coming, but we don't know what will cause it. That's the way markets operate. You will have an option when it occurs. Either panic like the majority or invest like the minority. One group will reflect with remorse. For the other person, it will be the best financial choice they have ever made.